A lot of the capital investment that we're seeing at the moment on a global basis is really being geared towards metals that can help in terms of renewables or green energy. And PGMs do play a role in that. And much of the growth that we saw in platinum ETFs not only helped to tighten the platinum balance, but it was largely being driven by longer term dynamics. And one of these dynamics has been the scope for substitution between platinum and palladium in autocatalyst, but also the potential growth for demand stemming from the hydrogen economy as well. Even if we've seen the start of the switching back towards pent-up demand from the auto sector, it's not going to be something that is resolved imminently.
Hello to viewers catching up on this virtual presentation, which forms part of our mining investment insights from across the Americas region. And I'm very pleased to introduce Suki Cooper, who is precious metals analyst at Standard Chartered, based out of New York. We're going to be hearing an update on the outlook for platinum group metals. And Suki, well, thank you very much for taking your time to share your current outlook with our investor and corporate audience.
Thank you for having me. So I'm going to share with you today our outlook for the platinum group metals over the next 12 months. It's been quite a volatile period for the complex as a whole. And as we can see on the price chart, that over the past 2 decades, there has been highs and lows that have been set across the complex. So on the first slide, you can see that in the past 2 to 3 years, we've traded a wider range across Palladium and Rhodium than we have since start of the century in 2000. So across this period, we've seen a number of demand shocks, a number of supply shocks, and that continues to be the case going forward, that these are going to be the key determinants factoring in the highs and lows for the complex. Rhodium prices fell by more than 20% in September, and at one point tested levels around about $11,000 per ounce. And that was a 1-year low before it bounced back. And bearing in mind, earlier in the year, it had tested levels close to $30,000 per ounce, and that was an all-time high that it reached in March. Palladium prices fell by a similar magnitude in September and dipped below $2,000 per ounce in recent weeks. That was the lowest levels we'd seen palladium trading since June 2020. And palladium prices had hit all-time highs above $3,000 per ounce back in May. In comparison, platinum prices have escaped relatively unscathed in comparison to its 2 sister metals, but it has been trending lower since May, dipping below $1,000 per ounce. Rhodium is the smallest market, so it is notoriously volatile, and it is at the mercy of the ebbs and flows of customer buying patterns. Semiconductor chip shortages have weighed on auto demand, and of course for rhodium, this makes up more than 90% of its end consumption. And we also believe that the rhodium market has been one of the markets where we've seen it swing from a deep deficit and now is likely to move into a surplus. So for much of the complex, once again, it's a combination of supply side shocks and demand side shocks that have impacted the market balance and the price action. So the return of supply and the impact of chip shortages were very much known variables by the time we entered the second quarter, but their timing was and still is highly uncertain. We knew that we would see a resumption of supply from South Africa following the outages at the Anglo concentrator plant last year in South Africa. And we also had the announcement of the stoppages in Russia due to the flooding and the concentrator outages at Nornickel. So while the developments in Russia were new at the start of the year, we did know that supply would be coming back across the complex as a whole. So at some point, prices would be facing some downward pressure from a better supplied market. And equally, the chip shortages were a known factor towards the end of last year, but it was also believed that we would see the turning point for chip shortages quite early on in the year, around March, and that would help to continue to support the PGM buying that we had seen. But the timetable for supply return has been volatile. We saw South Africa supply coming back in a meaningful way towards the end of the second quarter and into the third quarter. And with Nornickel, we saw the return of their supply in Q3. but equally the chip shortages tightness has impacted the market for a much longer period of time. So we've swung from a market that was significantly undersupplied in the first half of the year to one that we think is well supplied now, perhaps a market imbalance, but for some of these metals, a market that is oversupplied towards the end of the year. And we think that it's this shift in the balance that is likely to keep PGM prices under pressure in the coming weeks. So platinum was a market that we saw in surplus with heavy ETF disinvestment. But we think that now going forward, there are a number of factors that we need to keep an eye on. Firstly, the recovery in mine supply and recycled metals. Secondly, the negative impact of semiconductor chip shortages. And then the longer term impact that the development of the hydrogen economy has had on investor demand and on the balances in the near term and going forward. Firstly, looking at the supply side shocks, they have been most acutely felt across South Africa and in Russia. And it was the return of supply that were known variables in the second quarter that have helped to keep the market well supplied coming into the third quarter and towards the end of the year. So earlier this year, we knew that the most significant impact on supply came from Russia, and that impacted the palladium market most substantially. But now that we've seen the recovery of operations at Nornickel and the drawdown of in-process inventory from Amplats, we do think that supply is set to recover for the remainder of this year and into 2022. Having said this, we think that we'll see platinum supply recovering back to pre-COVID levels, but we don't see the same picture for rhodium or for palladium. For palladium, that's largely due to the fact that most of the supply is concentrated in Russia. And this is despite the fact that we are seeing the PGM basket price in South Africa trading at record highs. At one point this year, we saw the PGM basket price surpassing 50,000 rand per ounce, and it's now trading below 40,000. So despite favorable producer economics, despite the entire cost curve being cash positive at the moment, there isn't a near-term substantial increase in supply that we're likely to see. The growth in supply is likely to come over the next few years, but even then it's not likely to be a substantial increase. So in Russia, we obviously have from an increase in output from Nornickel, the fact that we'll see the bottleneck loosening, and we're likely to see an upgrade in their concentrator alongside their development of the Southern Cluster project. And it's this project that is likely to increase palladium supply substantially by the time we get to 2023, 2024. And in South Africa, we have the development of the Northern Limb operations and various other expansion projects that should help both palladium and platinum output. And of course, in North America, we have the deferred ramp up of the Blitz project. So these expansions are set to help to support the supply side picture, but they're also dynamics that are set to unfold over the next 2 to 3 years in quite a measured response, with the exception of the substantial increase that we'll see coming from Russia. But in the long run, even though there is some investment now, we're not seeing a substantial amount of capital investment. And this is largely due to the impact that the changes in powertrain usage is going to have over the next 10 years. So at the moment, we are forecasting that internal combustion engines will retain a substantial share of the auto market, but its share is likely to start to fall by the time we get to 2024, 2025 in a more rapid pace than we've seen over the past couple of years. So in turn, this means that PGM demand is likely to start to come under pressure. And it also opens up the question in terms of how much supply growth we should see over the next 10 years, given that this primary end use of palladium, over 80% of demand, a substantial end use of platinum, around about 40% of demand, is set to decline. A lot of the investment that we're seeing is not primarily in regions that will support a good growth in either platinum or palladium or rhodium over the next 10 years. So we now are in the near term, we see good supply growth, but longer term, we think that there's going to be some constraints around supply, primary supply. On the other hand, the other key driver has really come from the autocatalyst sector, and this has been the key swing factor across balances platinum, palladium, and rhodium over the past couple of years. There were expectations that we could see some substitution between platinum and palladium that could tilt the two balances, but also it was one end use where we were seeing tighter emission standards, increasing the average amount of palladium and platinum and rhodium that was being used across autocatalysts. But this is a factor that's been impacted by external drivers, primarily the semiconductor chip shortages that have now materialized across the sector. But if we look at the buying patterns that we have seen, we had assumed in terms of our auto balances that we would see much of the auto production that had been lost through 2020, a drop of 16%, being recovered through 2021. But we're now forecasting an increase of just over 10% in terms of global auto production. And we think we'll see a similar sort of number in 2022. On a key regional basis, we saw China's demand or China's auto sales starting to increase quite substantially since the start of this year. Sales are still up about 16%, but they started to fall over the past couple of months. A similar trend has been seen in Europe and across the US as well. But in terms of looking at the auto numbers themselves, we were previously forecasting a deep deficit for the palladium market in excess of 1 million ounces. But we now see that the bulk of that deficit was actually skewed towards the first half of the year, where we were seeing a good recovery in auto demand. There's much pent-up demand from consumers. Much of the buying didn't take place in 2020, and they've been trying to increase the appetite for buying cars has been strong on a regional basis, whether it's the US, whether it's Europe, whether it's China. There's been much pent-up demand, and we've seen auto inventories falling across the globe. In the US in particular, auto inventories have fallen to the lowest in our database, and our database commences in 1960. So we're far below the sort of average inventory auto levels, which normally typically tend to be around 59, 60 days. And we're at less than half of that level at the moment. So inventory is low. The consumer appetite is still strong, but the auto production isn't able to keep pace given the impact of the semiconductor chip shortages. And much of this stemmed from last year, where we saw chip manufacturers pivoting away from the auto sector, given the drop that we saw in auto demand, and instead pivoting towards the electronics sector. And electronics demand, of course, was growing last year, given the many people were working from home. And it's a long process time involved between switching between sectors. It can span between 6 to 9 months. So even if we've seen the start of the switching back towards pent-up demand from the auto sector, it's not going to be something that is resolved imminently. And these delays have been exacerbated by the impact of COVID-19 on production. And manufacturers have said that this could persist through to 2023 and into 2023. But in terms of the demand picture, we think that we will likely to see, at the moment, we're assuming that we'll start to see the demand recovering in the middle of 2022, but that could be pushed towards later in the year. And it's possible that we might not see auto demand recovering for the PGM sector until 2023. So initially at the start of this year, we saw a lot of strong PGM buying because many end users were concerned about the availability of metal. But now that we're seeing a decline in auto production itself, that's had a much more significant impact in pressuring prices lower so far in the second half of this year. Platinum has a slightly different story in that we've seen platinum imports responding very strongly from China when we've seen a price dip. So we saw imports exceeding 600,000 ounces in March of last year, when we saw platinum prices dipping to their lowest in almost 2 decades. And we've saw a similar trend in August, where we had the second highest imports into China, when we again saw a sharp sell-off in platinum prices. So the platinum market is obviously more diversified. There's maybe 40% of it's being consumed by the auto sector, but the jewelry sector still makes up a significant share of just over 20% as well. But the support that we've seen for the platinum market had been quite strong until earlier last month, where we started seeing dips in platinum prices below $1,000 per ounce. But going forward, we think that the market is likely to remain responsive to price dips, given that there's a scope for switching between platinum and palladium in autocatalyst use over the next 3 to 5 years. So the underlying demand for platinum, we think, will firm, but it's likely to be a slow process or a fragile growth in terms of platinum demand. The next factor that we were looking at is on the autocatalyst side. Here, it's a very interesting story in terms of the developments that we have seen across the spent autocatalysts that have been recovered. Normally, when we see high PGM prices, it tends to incentivize strong collection rates. But given the pandemic, we've seen a number of additional hurdles. So in light of auto inventory being low, in light of auto production not being able to keep pace with pent-up consumer demand, second-hand vehicle prices have surged. And looking at the index here, the Mannheim Used Vehicle Value Index, it's surged to all-time highs. And even though it's come off over the past month or so, it's still elevated. And this is alongside steel prices being elevated as well. Normally, when we have high steel prices, it also incentivizes strong collection rates of spent autocatalysts. There's more availability of spent autocats that can be recovered. And we tend to see a good response from the secondary market. But here that we've faced a number of hurdles. We do see palladium scrap market recovering very well. We've seen a good increase in supply, but we haven't seen that same trend in platinum. But we do think that the secondary supply of palladium and platinum is going to be important in the coming years if there are any further supply disruptions. But in terms of spent autocatalysts, there have been a number of hurdles, whether it's been due to high PGM prices, increasing the burden on working capital for many of the scrappage yards, or whether it's been the fact that we've had a limited number of smelters that can process the high silicon carbide levels in some of the diesel spent autocatalysts that are now coming towards the end of their life. So it's a combination of factors that has resulted in not necessarily the increase we would have expected from the secondary market that we've seen over the past year or so. But having said that, the growth in the secondary market, coupled with the recovery in supply from the primary sector, has been another factor that has pressured the PGM prices lower towards the end of this year. And it's another factor that we think will help to cap the upside momentum across the group of metals into early part of next year as well. So we've had the supply side shocks and the subsequent recovery in supply. We've had the demand side initial shock due to COVID, and then the increase in demand, and then the additional shock that stemmed from the auto chip shortage as well. So these two factors have meant that the market was very, very tight at the start of the year, and it's moved into a surplus or at least a balanced market for a number of the PGMs in the second half of the year. But one of the external factors that has impacted the balances as well has been the response on the investment side. Physical investment flows are important in terms of providing liquidity for the market. And we've seen in years where palladium has been undersupplied, that the palladium ETP holdings have provided a source of supply for the market to be able to meet that growth in industrial demand. In fact, we've had across the palladium ETF holdings, we've had net disinvestments for the past 6 years. And those palladium holdings have started to stabilize over the past year or so. And so far this year, holdings are actually up a modest 17,000 ounces. We see a different trend across the platinum ETFs. Here, it's a trend where platinum holdings continue to rise, where palladium holdings across all physically backed products has fallen to just over 500,000 ounces. Across platinum, they've touched levels almost close to 4 million ounces and now have dipped a little bit towards 3.7 million ounces. And much of the growth that we saw in platinum ETFs not only helped to tighten the platinum balance, but it was largely being driven by longer term dynamics. And one of these dynamics has been the scope for substitution between platinum and palladium in autocatalysts, but also the potential growth for demand stemming from the hydrogen economy as well. There are various estimates in terms of how strong that demand growth could be ranging between 400 to 700,000 ounces by the time we get to the end of this decade. But a lot of the interest, the investor interest that we were seeing materialize in platinum was being driven by some of that longer term demand growth, not demand that was going to materialize this year or even in 2022. So we think that the platinum ETFs have been an important source of demand for helping to absorb some of the excess supply in the metal, but it's also added some of the volatility in terms of the price drop that we've seen in the second half of the year. And equally, we've seen a similar response from shorter term investors as well. Tactical positioning across both platinum and palladium has now turned negative. So the gross short positions are much larger than the gross long positions that we've seen in the market. And a lot of this has been driven by the two major dynamics that we've discussed already in terms of the increase in supply, but largely in anticipation of the drop in demand that we could potentially see, given how long the supply chain challenges might persist across the auto industry. And that anticipation of demand falling further has seen some of the shorter term investors taking a more negative stance towards the complex as a whole, and net positioning has actually turned negative. So we've seen a number of key dynamics impacting the complex as a whole. And as we can see on the slide with the palladium balance, here we have a market where the market deficit is likely to persist through to this year, 2021. As I'd mentioned, we previously were expecting a deficit in excess of 1 million ounces, and now we have brought that in a little bit towards 700,000 ounces. But we do believe that the bulk of the deficit was actually concentrated in the first half of the year. And in the second half of the year, given the changing dynamics on the supply side and the demand side, we're likely to see a market that is most likely balanced, but has the scope to move into surplus in the fourth quarter. And here the key variable, once again, stems from the auto sector and whether the chip shortages will continue to impact demand more extremely in the back end of this year. Some of the estimates show that we could see a decline in auto production of almost 7 million units, and a magnitude of that much could reduce the palladium deficits further and bring the market closer to balance. So next year, we think that the auto chip supply chain will continue to be a key driver for palladium, particularly as we continue to expect a recovery on the supply side for the palladium market. So there's scope for palladium to remain in deficit, but we do think that what the market is focused on at the moment is the volatility that we see in palladium prices. Given the extreme levels that we see in tactical positioning in palladium, we think that any small supply disruptions or the potential for the chip situation to recover faster than what's being anticipated could place a lot of upside risk for palladium prices, given that a lot of short positions would need to be covered. But having said that, given that the auto chip manufacturers need a period of at least 6 to 9 months to be able to pivot towards increasing their supply, we think that near-term gains for palladium are likely to be capped. So in the near term, we see scope for palladium prices to recover modestly, but upside risk to be capped somewhat. But in the middle of next year, where we expect the impact of the chip shortages to start to fall away, that's when we think palladium prices will trade above $2,000 per ounce on a more sustained basis. For platinum, the market outlook is slightly different. We do see a market that has now swung back into surplus. And this is largely due to the fact that we have seen that decline in terms of autocatalyst demand. We have seen the recovery on the supply side, but also the fact that we've seen the ETFs swing from a form of demand to back towards a source of supply. And that has exacerbated the surplus for the platinum market for this year. We think next year the market is likely to be in surplus once again, but perhaps to the tune of just over 100,000 ounces. We think a lot of the risk for the platinum market has been priced in, but we think that there are a lot of longer term positive dynamics that are set to unfold for the platinum market, but these are dynamics that are not set to evolve for at least another year or so. So we could see the platinum palladium markets switching sides in the next 5 years. In the next 5 years, if we see substantial switching between platinum, palladium, and autocatalyst, and we also see growth in terms of hydrogen economy demand, we could see a platinum market that becomes undersupplied by the time we get to 2025, and we could see a palladium market for those same factors switching to a market that is oversupplied, particularly in light of some of the supply that is due to come on across Russia in the next 2 to 3 years. And then finally, in terms of the rhodium balance, this is a market which is a small market, and we don't usually see good byproduct. As rhodium is a byproduct, we don't tend to see good cost of production support or guidance for this market. So it tends to be much more volatile, as it is at the mercy of the ebbs and flows of buying patterns. But it's a market that has been impacted quite substantially by the auto sector as well. Around about 90% of rhodium is used by the auto sector. So given if we have a scenario where 7 million units of auto production fall away this year and potentially could be moved into 2022, it's quite easy to see rhodium swinging by almost 50 to 100,000 ounces, where it's gone from being a market that was due to be in deficit this year to one that now we forecast being at a small surplus. So our surplus forecast is just at 5,000 ounces, but we do think that rhodium demand is likely to remain strong at least in the next couple of years, but largely when we start to see a recovery in the supply chain challenges that we've seen. So across the sector, across the PGMs, we think that the key factors to keep an eye out for over the coming 12 months are really the turning point in the semiconductor chip shortages, the positioning that we see in terms of a tactical exposure across both platinum and palladium, given how extreme they are at the moment, and then really the China trade data to give us some indication in terms of where that demand is materializing and whether price dips are continuing to be viewed as a buying opportunity. We expect prices to remain vulnerable through to the end of this year with capped upside risk, but we think next year we will start to see more upside risk materializing for the complex as a whole. So for palladium prices, we do see prices trading back above $2,000 per ounce.
Excellent. Thanks, Suki. Really great and to get your in-depth analysis of where we're at with the PGMs there. You kind of sort of answered all of the questions that I had lined up really, but just a couple of other things that might be able to add around the vehicle sales analysis, and you sort of touched on it being very much irregular, and that the pandemic has created different sort of trends in behavior. Secondary sales have been harmed because I guess more people are wanting to buy a car now or looking at doing that. Is that because travel's kind of been disrupted, so everyone's doing domestic trips, so everyone's got demand for a car or something?
Especially across the US, we saw a trend last year where there was a rotation out of the city and into the suburbs, and consumers were initially buying their homes, and they weren't necessarily buying cars because no one was going anywhere. But now there's a desire to replenish those, renew those leases, or to buy that new car now that people have settled perhaps in their new locations. But a lot of consumers are finding that there's long lead times in terms of wanting to renew those leases or buy a vehicle. It may take up to 2 to 3 months to be able to get the vehicle that they want, or they're having to choose a slightly different color or a different model that they want. So rather than consumers being able to buy new cars, they're going back to the secondary market and keep either holding onto the cars that they already own, or they're trying to buy the car that they want, but it might be a secondhand vehicle instead. So it's created quite an interesting dynamic across new sales and across the used car market as well. But at some point when we see this recovery in terms of auto production, we should start to see some of those older vehicles being scrapped. So typically in our balance, we assume a vehicle life of about 13, 14 years, and that has now likely been pushed out to 14, 15 years. but at some point that metal will still come back to the market. But it might also be at the same time when we get to 2025, when we're expecting this increase in primary supply as well. So that could pressure palladium prices a bit lower in those years.
Yeah. Do you track the electric vehicle penetration rate against ICE and how that might impact sort of scrappage?
Yeah, so this is an interesting dynamic as well, because a lot of the expectations, a lot of the forecasts that we had in our balances are constantly being revised, and the penetration rate has been much faster than what we had been anticipating 2 years ago and just a year ago as well. So it's not necessarily had a big impact on our balances for this year, but certainly going out towards the end of this decade, it has a more substantial impact, and it is eroding some of that palladium and platinum demand that we had forecasted for the next 7 to 8 years. But in terms of scrap supply, it's a slightly different dynamic because you're waiting for that car to be retired. So even when we start to see the slowdown in terms of internal combustion engine sales, that if that vehicle is held onto for 13 to 15 years, you're still going to see that secondary supply entering the market. So even beyond 2030, we should have good supply from the secondary market in terms of palladium and platinum. And then depending on the market share that we see from fuel cell vehicles, that's still early stages in terms of it being developed. But we could see supply for platinum as well from that end use.
Yeah. That's an interesting area that, the growth around hydrogen fuel cells, certainly a lot more impetus for it, but quite a lot further off than in terms of it really impacting the consumer vehicle market.
I also find that's an interesting space to be looking at, because we've been talking about fuel cell vehicles for a number of years now, and it's something that was always in your long-term balance, not something that was impacting near-term balances at all. But now I think there's been a few interesting changes. And one of the recent highlights for me was looking at the role that fuel cell vehicles can play when it comes to heavy-duty diesel, large trucks. And the fact that this is not a market that can be easily penetrated by battery vehicles. So given that battery vehicles would be more expensive, more heavy, wouldn't have the same range, it's an area where you could really see substantial growth for fuel cell vehicles. And if we start to see the development of green hydrogen as well, then the amount of platinum that's likely to be consumed could be quite substantial. So I think there's in our balances, we assume that both pure battery electric vehicles and fuel cell vehicles can coexist the same way we see diesel and gasoline vehicles coexisting.
Yeah, that's interesting. Yeah, I just wanted to question you on the hydrogen fuel cell element of green hydrogen. Presumably, it's more intensive and and therefore it needs more of the PGMs in order to execute on that technology as opposed to blue hydrogen.
Yes, so there's obviously different technology that's being developed at the moment, but one process of electrolysis does use platinum and iridium, and there's a wide range of potential industry estimates. Some estimates show that by the time we get to 2030, we could see around about 400,000 ounces being consumed of platinum. Some estimates are closer to 650,000 ounces. So these sort of numbers are quite substantial, and they could have a platinum market that's undersupplied if we don't see the same sort of growth that we see and that we might need from primary supply. Maybe that could be satisfied by the metal that's being recovered on the recycled side, but the numbers could be quite substantial. It's still very much early stages because it's one of a few potential options in terms of development for the hydrogen economy. So it's potentially a very strong area of growth for platinum.
I want to flick back to what your analysis on China responding to the low platinum prices. Is it a case that they're stockpiling as opposed to just using it for direct jewelry or for industrial applications? China's obviously stockpiles a great deal of industrial applied metals to sort of help manipulate markets or indeed cope with their own supply demand balances in terms of refining and the midstream elements.
So for the PGMs, China is not a large primary producer of either platinum or palladium. So it's heavily dependent on either recycled metal or largely imports. But what we tend to see is that they have a much longer term view in terms of their future demand. It's not just what they need in the next month or the next quarter, but what they may need over longer term. And in terms of China rolling out its tighter emissions legislation, it had rolled them out on a slightly older engine platform, which meant that their loadings for PGMs were slightly higher than the global average that we tend to see, say, across Europe or the US. So there was scope for thrifting, reducing those loadings, but also scope for switching between platinum and palladium. So I think part of it is likely to have been driven by the eventual optimization of some of the catalyst loadings, where you might see a drop in palladium and an increase in platinum at some point. And I think some of it was driven by the recovery on the jewelry sector that we see as well. There was a strong recovery, at least in the first quarter and last quarter of 2020, when consumers were able to enjoy retail shopping again and in-store experiences, where platinum jewelry demand did recover. So I think part of it is taking opportunity for a longer term positioning and looking at the lower price as a good buying opportunity. And part of it is likely to be driven by changing industrial usages, whether it's driven by long-term fuel cell needs or potential switching between platinum and palladium in autocatalysts.
My last question would be around some of the commentary you gave around the lack of capital coming into, certainly on the mine supply side, and based around perhaps a deterring investment because of demand for ICE in the long run. You know, are you going to? Do you see this as bringing quite a big squeeze to the PGM sector towards the end of the decade?
It's certainly an area of concern because we've seen capital investments across PGMs falling over the past 5 to 7 years. Right. So it's a trend that's been in place for a while, and we know for new mines it takes maybe up to 8 to 10 years to bring new supply online. Maybe some brownfield projects can be restored on a much quicker basis, maybe in a couple of years. But there is a disconnect between the scope for demand patterns and the supply response. But a lot of the capital investment that we're seeing at the moment on a global basis is really being geared towards metals that can help in terms of renewables or green energy. And PGMs do play a role in that. Certainly platinum, with its use in fuel cell vehicles, plays a substantial role in there. But I think the investment or the investment projects that are being flagged at the moment seem to be those that are more so geared towards deposits that are perhaps shallower or and are not as capital intensive. But they also look to be deposits that are less skewed towards platinum, palladium, and iridium and rhodium as well. So it's something that I think is an area of concern, but perhaps we're not going to see the impact of that for quite a few years yet.
Indeed, very interesting. Well, Suki, that's fascinating to get a really in-depth analysis there. Thank you so much for presenting on the PGM's outlook and for speaking with us today.
Thank you for having me.